Good afternoon and welcome to the AFS Best Practices Leadership webinar. Thank you for joining us today. Our topic today is a review of the first quarter 2022 commercial lending landscape. This webinar will be approximately an hour long, and our speakers today are Don Doherty, Jeremy Chalson, and Rob Lynch. Before we get started, there are a few reminders for today's event. We encourage questions, so please use the Q&A feature to ask your questions. We will leave time at the end of our prepared remarks to answer as many questions as possible. We are recording today's session, and tomorrow you will receive an email with a link to listen or download the presentation. Thank you for joining us today. Don?
Thank you, Lisa. Hello, everyone, and welcome to our webinar, Pricing Fundamentals, a review of the first quarter 2022 commercial lending landscape. We here at AFS know how busy all of you are, and as always, we really appreciate you taking the time to join us today. As we get started, I want to say that we certainly welcome any comments any of you may have on today's webinar. Our contact information is provided at the end of this presentation, so please do not hesitate to reach out with your questions. It is worth noting that the source of the data presented today is from the AFS Pricing Service. This database is the industry source of pricing trends for commercial lending and contains a robust offering of measures and dimensions, allowing banks to tailor the analysis to their own unique footprints and exposures. This database is also used to prepare our Pricing Trends monthly newsletter. Again, please reach out to us if you are interested in learning more about our pricing service or if you are interested in receiving our monthly newsletter. On slide 4 is our agenda for today, which continues to be influenced by our customers and prospects, and we thank you for your continued feedback. For today's presentation, we will start with a look at the broader market and economic forces shaping commercial lending trends. Next, we will analyze trends in commercial loan growth. And as many of you are aware, commercial loan growth for the industry as a whole accelerated at the end of 2021. And it was nice to see that rebound extend through the first quarter of this year. Following our loan growth analysis, we will look at market trends in commercial loan pricing and fees. From a loan pricing standpoint, March was significant in that we witnessed the first Fed rate hike in more than 3 years. With yesterday's rate hike and more rate hikes likely in the coming months, there are forces that may temper the benefit that banks realize in the form of higher margins. These forces include excess liquidity in the banking system today and fierce competition for the best customers. We will finish up today's presentation showing you an example of how we provide these types of pricing analytics to our client banks. Specifically, we will provide an example of what we call a pricing guidance file that you can think of as a way to visualize pricing opportunities and risk-return deviations within your bank's own portfolio. On slide 5, we provide a summary of the U.S. economy and highlight 4 variables central to commercial loan demand. In our last webinar, we noted that the economy was heating up and C&I loans were growing. Since that time, the impact of Omicron on economic growth has become apparent. Real GDP growth, which is a leading indicator for commercial loan growth, was negative for the first quarter of 2022, ending the expansion we have seen for the last year and a half. What is becoming a bigger headwind for loan growth is inflation. The year-over-year change in the CPI remains well above historical norms, even when excluding food and energy prices. High inflation prompted the Fed to raise short-term interest rates in mid-March. And yesterday, another Fed rate hike, again in response to burgeoning inflation pressures, which at 50 basis points was the largest rate increase since May 2000. The challenge the Fed has, and the challenge for bankers, is that interest rate increases could hinder economic growth and dissuade borrowers from taking out new loans. Thankfully, in terms of commercial loan growth, some macroeconomic measures are still favorable. For example, the labor market is pretty much at full employment, with the unemployment rate trending at 3.6% at quarter end. And while business confidence has taken a hit due to the fallout from Omicron and the Russia-Ukraine conflict, it is still trending well above the long-term average. Altogether, these factors make forecasting loan growth over the next year a difficult exercise. Despite these uncertainties, there are a handful of segments in the commercial loan market that continue to expand at a rapid pace. Rob will highlight these sectors and geographies in the loan growth section of today's presentation. Next, on slide 6, from a historical point of view, there is currently an imbalance between loans and deposits. Government stimulus and support at the start of the pandemic injected an enormous amount of cash into the banking system, and the resulting impact was a surge in deposit growth. Conversely, loan volumes outside of the Paycheck Protection Program were slow to grow, and for some sectors were down throughout the pandemic. The result is that the industry-wide loan-to-deposit ratio fell from between 70 and 75% a few years earlier to between 55 and 60% at the end of 2021. This imbalance has definitely made loan growth a top priority for many commercial banking executives, which has been reiterated on several first quarter earnings calls. The loan to deposit trend has implications for loan pricing as well. Banks looking to deploy idle liquidity will compete aggressively for borrowers, and this competition may temper the increase in yield banks can expect from the anticipated rate hikes during 2022. Whether or not competition for loans is intensifying is a question we will analyze throughout this webinar, especially when Jeremy presents trends in spread and fee pricing. A recent article capturing some of these pricing dynamics is presented on slide 7. You are probably familiar with the term deposit betas. Well, an interesting complement to that term, loan betas, is used here. Loan beta is defined as the percentage of changes in the Fed funds rate that banks pass on to borrowers. So, as an example, how much does a 25 basis point increase in the Fed funds rate affect the weighted average interest rate for C&I loans? The authors here believe that excess liquidity in the banking sector will spur competition for credit, and they anticipate that loan betas in the coming years will be beneath what we saw during the previous Fed tightening cycles. This notion of competition and loan betas is an interesting one, and later on we will approximate loan betas for various industry subsectors. And now for the next part of today's presentation, I turn it over to Rob Lynch for an in-depth view of loan growth. Rob?
Thank you, Don. Good afternoon, everyone. Looking at loan growth for the period on the next slide, we find that despite some of the recent headwinds to the economy that Don touched on, commercial lending managed to post an increase in March. Here we've plotted a long-term trend in monthly loan growth rate. Note that the C&I figure includes PPP, or the Paycheck Protection Program loans, and which accounts for some of the volatility in the blue series. Both C&I and CRE lending increased during the first quarter, and in looking at the chart on the right, CRE lending showed steady growth from December 2021, despite several banks expressing concern about exposure to office and lodging properties. C&I, which dipped a bit to start the year, still ended March higher than it was in December of 2021. On the next slide, this chart compares balances in each month to a December 2019 baseline. There you go, which is indexed at 100. So a value above 100 indicates that balances in the month were X percentage points higher than they were in December of 2019, while a value below 100 means that balances were X percentage points lower than December of 2019. The blue series represents commercial lending, including the PPP, and the orange series represents commercial lending excluding PPP. Notice that since December of 2021, balances have continued to grow through the first quarter to the highest level seen since the onset of the pandemic. Also note that the differential between the blue bar and the orange bar in March of 2022 is very small, and this represents the small remaining PPP balances outstanding. So to summarize these first two slides, balances for commercial lending were up in the first quarter despite the interest rate hike and the macroeconomic headwinds that we saw. On the next slide, we break down loan growth by geography and industry. In the left-hand chart, note that Texas, Alabama, and New York all had large increases in loan growth. In Texas, oil and gas were not the predominant driver of loan growth, but rather telecommunications and wholesale trade were. We will have to see if this changes over the coming months as gas prices are projected to remain high for the foreseeable future. In Alabama and New York, the finance and insurance industry was the main driver of growth, followed by machinery manufacturing in Alabama and real estate in New York. From an industry perspective, the right-hand chart shows that manufacturing, both for machinery as well as food, beverage, and apparel, led the way along with wholesale trade. Manufacturing of machinery and electronics was strong in Pennsylvania and Tennessee, and specifically in Pittsburgh and Memphis, respectively. Manufacturing of food, beverage, and apparel was prominent in Maryland and Missouri, specifically Baltimore and St. Louis. And wholesale trade was strong in California and New York, in Los Angeles, New York City, as well as Buffalo. On the next slide, we'll take a deeper dive into the manufacturing industries previously highlighted. The left-hand chart shows that all the subsectors for the manufacturing of machinery and electronics exhibited growth, with primary metal manufacturing showing the highest growth at 17.8%. In the right-hand chart, we see that manufacturing of food, beverage, and apparel shows a different picture. While there was strong growth in the apparel, leather, and food subsectors, it was slightly offset with lower growth in textile mills and beverage and tobacco products. Next, on the next slide, we'll drill down to a core-based statistical area, or CBSA level. On this slide, we take a look at loan growth across the country and highlight the largest growing CBSAs. You can view this as a heat map of sorts, with the larger bubbles indicating the strongest growth cities. In the first quarter, the Dallas metro area showed strong growth, coming primarily from telecommunications. In the Northeast, New York, Baltimore, and Boston all showed strong growth. Finance and insurance and real estate were the main drivers in New York City. Healthcare and food manufacturing were the drivers in Baltimore, with Boston being a more broad-based growth with multiple industries showing a moderate increase. Next, let's take a look at revolving lines of credit. As we highlighted in previous webinars, line utilization is a key component of loan growth, and during the last 2 years has been below historical averages. Over the last 6 months, we have seen a gradual increase in utilization, thereby helping overall loan growth. The top chart shows a trend for bilateral line utilization, and you can see a continued slow uptick in utilization in the first quarter, going from 34.6% at the end of December to 35.2% at the end of March. In the bottom chart, we're showing some of the industries with the largest movement in line utilization. The most pronounced increase is in 311 food manufacturing, which just crossed over the pre-pandemic average noted by the dashed line. 333 machinery manufacturing is still well above the pre-pandemic average, along with well below the pre-pandemic average, along with 623 nursing and residential care. But both made advances in the current month, while 237 civil engineering and construction is far above the pre-pandemic average and continuing to increase. Next, we'll move to new and renewed volume. This slide shows a trend of new and renewed volume for C&I and CRE loans. As depicted on the chart, there was a substantial increase in both the current month as well as from the year ago period for both new and renewed balances. This growth was both from an increase in the line utilization, as we saw in the previous slide, as well as new loan generation and renewals being closed. The next chart shows new and renewed balances broken out by industry segments. Real estate garnered the largest share of new and renewed balances overall, but were slightly down in the first quarter of 2022 from the fourth quarter of 2021 as a percentage of overall new and renewed balances. Of the highlighted subsectors.
Can we go to the next slide, please?
Oh, sorry. There we go.
Thank you.
Thank you. Thank you, Jeremy. Of the highlighted subsectors, 3 are in the finance and insurance industry. And combined, they capture a very large share of new and renewed balances. It is important to note that many of the borrowers in these subsectors are private equity firms and non-bank lenders that cater to riskier borrowers. It will be interesting to follow these balances over the coming months to see how they hold up in the current rising interest rate environment. With that, I'll hand the discussion over to Jeremy Charlson, who's going to give us an update on pricing, spread, and fee metrics. Jeremy?
Great. Thank you so much, Rob. Really a pretty interesting quarter. I think we were pleasantly surprised to see that growth was indeed positive, despite some of the cross currents that Don had pointed out in the economy. So hopefully that trend will continue in the second quarter of this year. Renee, could you go to the next slide, please? So for this pricing section, we'd like to begin with a look at the broader pricing environment. And what we have here are trends in 4 market rates that are all very relevant to commercial loan pricing. Now, as Don pointed out, March was very significant in that we witnessed the first Fed interest rate hike in more than 3 years. That occurred in mid-March, and then as Don pointed out recently, on May 4th, Star Wars Day, for those of you that are Star Wars fans, we saw another very large Fed increase. So here, if you kind of follow in clockwise order, you can see that in mid-March, we did see that rise in the federal funds rate. Now, the short-term impact of this move is that commercial loan yields did increase. We'll show you an example of that in just a moment. And that will have a favorable impact on NIMs. I think the question is, going forward, how much of this increase is actually going to translate into higher margins for banks? We're still hearing anecdotally from all of you on the line and from the client banks that we work with that competition is still very intense, and that could limit the loan betas, that term that Don used, going forward as the year progressed. Now, for the time being, that is, banks with higher percentages of floating rate loans, for those tied to, say, Prime or SOFR, those banks will experience the most benefit in the short term. And you can see here on the slide that the prime rate, the bank prime rate, and daily SOFR rates both increased in March following the Fed interest rate hike. The SOFR trend plotted here in the bottom left, that's actually daily SOFR. And while a material amount of the loan volume is still tied to daily SOFR, we're seeing an increasingly large share of net new commercial loan volume tied to 1-month term SOFR. So as a reminder for you not maybe familiar with kind of all the SOFR dynamics, SOFR is a backwards looking risk-free rate as contrasted with LIBOR, which is a forward-looking credit-sensitive rate. And to make SOFR more forward-looking, in recent months, the derivatives market has synthesized a term structure based on SOFR futures. Now, when SOFR was first introduced, there was some concern that it would be more volatile than LIBOR, and in particular that it would perform differently than LIBOR or the related Ameribor during periods of stress, such as COVID-19, and to a lesser extent what we're experiencing now with the fallout from the Russia-Ukraine crisis. So the implication is, well, what would this mean for banks in terms of the credit adjustment that banks have to add for SOFR if we're seeing pretty wide divergence during periods of stress? Now that the Fed has raised rates, the gap between 1 month LIBOR and 1 month SOFR, that has jumped to over 14 basis points. That difference had been negligible when the Fed funds was at the zero lower bound. So again, it does raise some questions about how banks are going to incorporate SOFR into their pricing decisions, and specifically how they're going to adjust for the credit adjustment to make SOFR more LIBOR or Ameribor-like. We kind of get at that idea here in the bottom right graph, where I'm plotting the trend in SOFR as well as Ameribor being a credit-sensitive rate similar to LIBOR. And you can see the difference in the 30-day average as that gray bar behind the lines. That difference has increased in recent months. It hasn't spiked or gotten too volatile, but it's definitely something to keep an eye on, because if credit markets remain somewhat volatile, whether because of the Russia-Ukraine conflict or some other headwinds that Don and Rob had alluded to, we could see a wider divergence between SOFR and these credit-sensitive rates. Again, that can be a very important factor to consider as the market moves more and more away from LIBOR and towards rates like SOFR. Next slide, please, Renee. So here we can see the impact the most recent Fed rate hike has had on recent new and renewed loan pricing. We have a picture for C&I loans on the left and then a picture for CRE on the right. So what you can see here is that if you look quarter over quarter for C&I loans, the weighted average interest rate increased 6 basis points for the new C&I deals, and it was up 11 basis points for the renewals over that period. While it's not shown here, if we would have split this trend by index, the C&I loans with fixed pricing had the largest quarter over quarter increase, followed by floating rate loans that were tied to SOFR. I actually think what's a little bit more interesting is that we actually observed quite a bit of intra-month volatility in March, specifically around the Fed's rate hike. For C&I loans, average pricing in March was actually lower after the Fed rate hike compared with the weeks before. Now, it was not a dramatic difference, but I think it speaks to that theme of intensifying competition that Don alluded to, where perhaps customers are trying to lock in low pricing or as low as possible before rates increase even more. I think that's definitely going to be a driver not only of loan growth, but one that's going to impact some of the pricing trends we see going forward this year. Now, compared to the trend for C&I loans, the CRE deals on the right, they experienced a larger quarter over quarter lift in pricing. You can see on the right-hand side that the weighted average interest rate for new CRE deals, that was up 19 basis points during the quarter, while the CRE renewals were up 21 basis points. The reason the CRE deals had a larger swing or a larger uptick really relates to the credit characteristics of the CRE deals. What we saw from 4Q to 1Q is that if you look at the default likelihood of C&I loans, whether you measure that in terms of, say, a weighted average obligor risk rating or a weighted average probability of default, that really didn't change too much quarter over quarter for C&I. Whereas the CRE deals, the weighted average PD, the weighted average default likelihood, that did have a pretty sizable increase from December to March. So I think that bigger pricing increase we're seeing for CRE loans versus C&I reflects the fact that perhaps the CRE credit quality deteriorated a little bit. I know Rob mentioned that some banks have expressed some hesitation about continuing to lend to, say, office properties. You know, what kind of this new hybrid work from home model is going to mean for that property type. But it was actually the deterioration in credit quality that explains why CRE loans had a higher increase in their weighted average interest rate. Next slide, Renee. Thank you. So from a loan pricing standpoint, one of the most significant drivers of the recent trends that we're seeing has been the uptake in SOFR volume. So a year ago, LIBOR was the predominant index in the commercial loan space. You can see for C&I loans, which are the top two distributions, a year ago, LIBOR was approximately 2/3 of all C&I volume. LIBOR is that light blue slice on that donut chart there. But as of March of this year, 1Q22, LIBOR was only approximately 1/5 of the total volume. That still seems like quite a bit given this stage in the transition cycle. What we're seeing is that there's actually very little brand new lines of credit or new term loans tied to LIBOR. Instead, the majority of that 21% that we were reporting that's still tied to LIBOR, that was actually new draws under existing lines of credit. So that's where, for example, the pricing terms are still tied to LIBOR, but they're not brand new lines of credit. They're not brand new term loans. We saw maybe one or two of them still tied to LIBOR. Banks are working with regulators to pass through a few exceptions, but again, this is mostly vintage activity with new draws tied to LIBOR underneath them. Now, in place of LIBOR, SOFR, which is the yellow series on these donut charts, that has become the leading index for C&I loans. It's a little over 1/3 of all the volume, new renewed volume reported in 1Q22. Daily SOFR was initially the most popular flavor of SOFR used to price C&I loans. But as of March, 1-month term SOFR, and we mentioned that the derivatives market has created a term structure for SOFR, that is being used more and more to price C&I loans. Interesting that thus far, we haven't seen too many new or renewed loans tied to Ameribor, which is kind of a complementary index to LIBOR. I think the reason for that is there's really not nearly as much underlying transactions or volume tied to that or supporting that index as, say, SOFR. Although we have heard that some small banks do prefer Ameribor for its simplicity. By comparison, BSBY, which is the red series, we have seen some traction in the C&I space around that particular index. That comprised about 4% of the new and renewed C&I deals as of March. Unlike SOFR, BSBY is a credit-sensitive rate, so no credit adjustment or spread is required when originating loans tied to that index. So that does have some appeal compared with, say, using SOFR to price new and renewed loans. In the bottom charts here, we have the same picture for the commercial real estate portfolio. And similar to the C&I trend, we can clearly see the migration away from LIBOR to other floating rate alternatives for CRE loans. Specifically, SOFR has become more entrenched in the CRE space than actually C&I. More than half of all the CRE new renewed volume in the first quarter of 2022 was tied to SOFR. So it really shows you just how intense and pronounced that migration has been year over year. The percentage of CRE loans with fixed pricing, fixed here is the dark blue series, that was up only modestly year over year. And that's actually a trend that surprised me a little bit. Neither C&I nor CRE really saw a big increase in fixed rate volume. Before looking at this data, I would have guessed that perhaps some customers may have tried to lock in low fixed rates, since we know that we're currently underway with a Fed tightening cycle and rates are going to go up. But I think one dynamic to consider here is the impact that non-banks have had both in the middle market space and for commercial real estate lending. What we've seen over the last several years is that an increasingly large share of borrowing has moved into the secondary market, where companies like insurance companies or other non-bank firms are getting really aggressive with term structures and fixed pricing. And I think to some extent, we're seeing that reflected in these charts, where commercial banks are exercising more discipline when it comes to fixed pricing, and perhaps may even be losing some of that business to these other financial players that are much more aggressive with things like duration risk and fixed pricing. Next slide, Renee. Now, earlier we asked the question of whether excess liquidity in the banking system would intensify the pricing competition for new loans. So recall that Don had plotted the trend in the loan to deposit ratio, and it really shows you just how much that ratio has come down over the last several years, which is going to really spur banks to make loan growth a priority, and by consequence, we might see more competition. So here's a barometer for that. We're looking at weighted average spreads on new and renewed C&I loans tied to prime. While spreads on prime-based loans, they have oscillated over the last several quarters, the overall slope of the trend is downwards. In fact, in 1Q22, we actually saw the lowest average prime spread in several years. That came in at 23 basis points, which you can see is much lower than typically what we've seen in prior quarters. Now, one explanation for that low prime reading in March, it could very well be competition, that some banks, again, are willing to cut spread or offer lower spreads in order to win volume. But I do think there are a few other factors to consider here. For instance, some banks that we work with have been slower to adopt SOFR than others. And in fact, more than one bank in our database appears to be using prime as a temporary substitute for LIBOR. So to render the prime loans more LIBOR or SOFR-like, if you will, these banks issue prime loans with negative spreads so that the effective rate is equal to a LIBOR or a SOFR loan with a positive spreads. And I think it's some of these prime loans with negative spreads that are probably weighing down the average to some degree in 1Q22. Now, the practice of offering prime spreads with negative or prime loans with negative spreads, I think that has a type of what you might call psychological or marketing appeal. So recall that with SOFR, whether it's daily SOFR or term SOFR, that requires both a regular spread as well as a credit adjustment, since again, SOFR is a risk-free rate. So SOFR is essentially, so banks that have baked the credit adjustment into the spread for SOFR loans, it does make the margin appear higher for the SOFR activity, even if the all-in rate is comparable to what we'd see for a LIBOR loan or a prime loan. Having to incorporate that credit adjustment into the regular spread for SOFR loans, again, it makes the margin look higher, and for some customers, they might be balking at that. So being able to instead say, hey, we'll give you a prime loan with a negative spread, again, even though it's the same effective rate, I think there is some psychological appeal to doing that. So it's really just another example of how SOFR has changed pricing dynamics in the loan market, and certainly a trend that we'll continue to update you on in the months that follow as SOFR uptake continues to gain traction in the market. So speaking of SOFR, here we can actually look at spread pricing trends for the SOFR loans, and we've divided it into C&I on the left and the picture for commercial real estate on the right. Now these spreads are the quote unquote total spread of the SOFR loans, meaning they're inclusive of the credit adjustment that banks have to bake into them. What we saw for C&I loans on the left is that spreads on new renewed loans tied to SOFR really varied widely during the second half of 2021. That was because market adoption of this index really didn't accelerate until much later in the year. The volume then began to stabilize around November and December. So I think it's the fact that we really didn't see a heck of a lot of SOFR loans early on for why those spreads were oscillating from 160 bips all the way to 209 earlier in this trend. Thankfully, that trend did stabilize through the first quarter. SOFR spreads, they were up from February to March for C&I loans. You can see they went from 174 to 184. They were down ever so slightly, though, on a quarter-over-quarter basis. Now, for CRE loans on the right, the weighted average SOFR spread oscillated within a pretty narrow band over the last several months. As of March, the average SOFR spread for CRE loans was 211 basis points, which was well above the C&I average in that same month of 184. Note, though, that the CRE loans, again, they typically display less favorable credit risk than the C&I volume. But I think the higher spreads there in the CRE space reflect the fact that more of those deals are risk rated, say, low pass than we're seeing in the C&I space and for C&I loans tied to SOFR. Next slide, Renee. Thank you very much. Now, speaking of credit risk, there certainly are some broader economic frictions that could impact the outlook for commercial loan credit quality, as well as the trends in spread pricing that we're going to see going forward. So these include, among other things, we have the fallout from the Russia-Ukraine crisis, which in some cases really exacerbated prices and even supply chain issues in some cases. Inflation is still very, very high. That's a mixed bag in terms of loan growth, but one way it can hurt loan growth is that if it dents consumer confidence or it dents consumer spending, that can hurt businesses as well. And then we still have, supply chain issues and just other bottlenecks that really are impacting many businesses across the country. The bond market appears to have priced in some of these risks. So credit spreads, such as the difference between the BBB bond yield and the 10-year treasury, that's the red line we have plotted on the top chart. Credit spreads, if you measure it in that respect, have actually widened quite a bit from December to March. I think it's actually a little bit above the historical average as of the end of March. So we thought it would be interesting to see whether banks are in similar fashion tightening spreads for riskier borrowers. Surprisingly, when we look at the new renewed SOFR volume, we're not seeing that same trend play out in the C&I lending space. In fact, for the low pass borrowers, those rated 06 on our standardized obligor risk rating scale, SOFR spreads actually narrowed year over year. I was a little bit surprised to see that. I would have thought that perhaps banks might have gotten a little bit more conservative in terms of pricing for that area of the market, because that's where a lot of the leveraged loans are, and it's right before a special mention rating on our scale. And really across the risk spectrum on a quarter over quarter basis, spreads were either only marginally higher or actually down when you stratify it by risk. The only segment to actually see an increase in SOFR spreads quarter over quarter was the best risk band, funnily enough, where it went from 107 to 122 bips year over year. Now, this doesn't necessarily mean that banks are getting too aggressive or that they're not concerned about some of the broader economic forces at play here. I think for a lot of the regional banks that we work with, they're probably a bit more insulated from things like the fallout from the Russia-Ukraine crisis. I know that while some businesses are concerned what it's going to mean for economic growth, and certainly inflation is a top of mind concern for a lot of businesses, we have seen that in some parts of the country, growth is still very robust. Rob had that chart a little while ago where he looked at growth by state, and you can see some areas of the country are still growing very rapidly. So it could be competition is weighing down spreads. It could be that banks are saying, well, at least for the moment, we're not terribly concerned about default risk. Credit quality is still pretty good, and therefore we don't see a need to tighten spreads for the riskier borrowers. This could change as the year goes on, so we'll definitely keep you abreast of those trends. But for now, we are not seeing spreads increase materially, or we're not seeing banks tighten standards when we look at pricing stratified by risk. Next slide, Renee. So in prior webinars, we made the point that market trends vary widely by geography. Even when we isolate for things like industry, risk rating, whatever it may be, we still see statistically significant differences across the country in terms of rates. What we have here is kind of a heat map, if you will, of pricing across the country. So the numbers as well as the colors indicate weighted average interest rates for the country. Really shows you just how diverse those profiles can be. We have, and part of this reflects the strengths of the local economies. Some states perhaps are growing faster than others. It could reflect the number of banks in a given state or a given metro. Some areas of the country are more competitive than others, but boy, there's really a great deal of diversity when you stratify it by geography. Whenever we onboard a client to the pricing dashboard, we always look at these kind of trends across their footprint. And one of the ways that we can deliver market information to you is actually create pricing scorecards that reveal average rates, spreads, and fees by size and tenor for your individual metros. So we can take all the views that you see here in this webinar and focus it just on the cities that you operate in to really account for the diversity that we're seeing here in pricing. Next slide, Renee. And here's kind of one such example of that, where I've actually drilled into a number of local markets. We have some of the biggest CBSAs in our database, areas like New York, Philly, Atlanta, and so on. And I mentioned that pricing varies across geography, but the same can be said within individual markets. Even when you look, say, just in New York or Philadelphia, we see wide pricing dispersion across the banks. One thing I like to do, and one thing we like to do with our clients when we're first kind of onboard them to the service, is we like to look at the dispersion between the min and the max bank in each of those metros, because that's a really good barometer for the degree and magnitude of pricing competition in those markets. And in particular, I like to look for cities that have low and narrow profiles. You can see maybe Boston's a good example of that, Boston being plotted second from the left, where its average spread is beneath the national average, and pricing tends to be very narrow and skewed a little bit lower than we're seeing for several other markets. That would indicate that banks in Boston don't have a great deal of latitude to price above the market average. So again, we like to look at this whenever we onboard a new bank. We like to look at, for each of those cities, which ones are the most competitive, and conversely, which ones might have more pricing variation within them. Because markets that have wider tails, those could be opportunities where perhaps you could increase spread. So it really, again, shows you just how important geography is to pricing model. And again, we work with banks to really analyze these trends at a very granular level. Now, like geography, industry is another dimension against which pricing can vary quite considerably, both in terms of average interest rates and trend sensitivity. So I want to go back to a term that Don used, which was loan betas, which again is really defined as how much of the change in the Fed funds rate is distilled into loan rates, say weighted average interest rates. And so I've tried to approximate here loan betas for 10 industry subsectors, 10 three-digit NAICS industries. And what I did to really kind of filter out or isolate for credit risk, because I'm just looking at loans risk rated 05, which is average on our standardized obligor risk rating scale. And that way, if we see a change in pricing, it's not attributable to a change in credit quality. Rather, it really is that pricing went up or down in that particular subsector. So the 5 industries at top, these were from February to March, the sectors that had the highest change in yield. And conversely, the industries at the bottom are the ones that had the lowest change in yields. You can see that on a month-to-month basis, credit intermediation, that went up 77 bips when adjusting for credit risk, followed by motor vehicle, and then oil and gas. So these are the sectors you might say have the highest loan betas month over month. And it'll be interesting to see if these profiles or these sectors continue to be the ones that have the largest increases in pricing as the Fed continues to raise rates. Conversely, the sectors at the bottom, they did not have a big change in rate month over month. And despite the increase in the Fed funds rate and the prime rate and SOFR, there were a few industries that even when adjusting for credit risk, actually had a decline in yield. Industries like wholesalers, which Rob had pointed out as being a big growth sector, food services, and nursing care. So it really just shows you again just how important industry is when trying to understand pricing trends, and that some sectors are much more sensitive to changes in the Fed fund rates than others. We like to work with banks to create what you might call an efficient frontier, where we'll look across the industry spectrum and we'll say for a given level of credit risk, what mix of industries would yield the highest return for that given level of risk? Or in thinking kind of loan betas, what would be the mix that would generate the highest loan beta in a rising rate environment? Our data can certainly help inform that for your bank. And we'd love to have that conversation with you to see how we could help you figure out what industry mix or what subsectors would help you achieve a target NIM or a target loan beta in the months to follow. Now, fees are another really important component of loan pricing, and it's one that's actually sometimes ignored. I think there's so much of a focus oftentimes on just the spread and the rate, but fees are really an unrealized revenue opportunity for many banks that we work with. And when we onboard a bank, one of the first things that we do is analyze fee trends in their footprint. Here at maybe a more 10,000 foot view level, we're looking at market average fee levels and fee incidents. The level being the blue or the pink line here, and the fee incidence, which is how often banks assess a fee, that's the blue series. What this tells us is that in March of 2022, of all the new renewed transactions, a little bit more than 20% of them were assessed a fee, and the average level of those loans assessed with a fee was about 27 basis points. What's interesting to note here is that whether you look at level or fee penetration as measured by incidence, fee performance eroded year over year. We're seeing lower levels, lower incidence. Again, going back to that theme of competition, I think that perhaps that is impacting the quest or the competition for new loans. I think we are seeing that reflected in this downward trend in fees. Another kind of interesting trend correlation here that you might notice is that typically when fee incidence is higher, fee level declines. So when banks are able to get fees more often, unfortunately, it often is at lower levels. This kind of mirrors what we see with spreads and new renewed volume, where when volume is more robust, oftentimes spreads are a little bit lower. So there could be kind of a supply and demand factor and dynamic here, but it's a really interesting correlation. And again, it really speaks to some of the competition that we're seeing take hold in the commercial loan space. Now, an interesting way to stratify fees is by commitment size. And similar to when we look at this by interest rates, there is in general an inverse correlation between fees and commitment size, where fee incidence as well as fee level tends to decline as you work your way up the deal size spectrum. If we look year over year, what's interesting is actually fee penetration really declined in the smaller end of the market. So you can see for the smaller end loans, those that are under 250,000 in size, maybe more of your business banking loans, fee incidence declined from 22% to 16%. And we saw declines of similar magnitude for loans that are less than $500,000 in commitment size and those less than $1 million. But still on an absolute basis, the fee incidence, fee penetration, as well as the fee levels, they tend to be a lot lower in the larger end of the deal size space. That's because the credit quality of those deals tends to be better. We also tend to see a bit more competition in the larger end of the market. And so that's reflected in some of these lower fee metrics that we're seeing by size. But again, this is a really important driver of fee performance is deal size. And again, we'll continue to update this picture in the months that follow. Now, as Rob had pointed out in his loan growth section, the first quarter was a strong period for loan growth. We did see total outstanding balances increase throughout the quarter. But in addition to growth in bank loans, we also saw growth in unused commitments as well. So in parallel, while outstandings were growing, so was the total exposure, and in some cases, the unused amount that we were seeing. And so this has brought a renewed focus on unused fees and how that practice varies across the marketplace. I will say with the banks that we work with, it varies considerably. For some banks, it's a matter of policy to really focus on getting unused fees. Others are more willing to waive this particular fee type. And I think in terms of levels, that disparity is really reflected here. What we're plotting here are unused fee levels across the banks in our database, and we've arrayed that in terms of quartiles. We can see the min bank in terms of unused fee level, the max bank, and then the bottom and upper quartile banks as well. And you really just see how much unused fee levels vary across the market participants. Now, I will say that this can also vary by line of business. It can vary by sector. For some reason, the practice of assessing both upfront and unused fees varies by industry. Some industries it's just not a practice to do so. But these are deviations that we can always illustrate and pinpoint with the banks that we work with. So if you're interested in understanding more of how these dynamics are playing out across your footprint, or you want to see, for example, for a particular line of business you're focused on, say the healthcare industry, what these look like, please give us a call. We'd love to show you how our service can illustrate those opportunities for your bank. And just sort of to close out the presentation, I know we're coming up on the hour, I just wanted to show you one kind of real day in the life example of how we deliver pricing analytics to the banks that we work with. So we have a number of ways that we can deliver pricing information to banks. We have an online dashboard, which is more kind of a top-down way of analyzing market trends, similar to the charts and the views that you saw here in this webinar. But a really popular way of delivering the analytics is through what we call a pricing guidance file. And with that, what we do is we take all of your new renewed transactions in the period. We plot some indicative characteristics for them, like the industry, the line of business, the duration of them. And for each one of those transactions in your portfolio, we derive a market equivalent rate, spread, and fee level based on loans that share the same tenor, industry, geography, and so on. And that way we can illustrate pricing opportunities and gaps directly for loans in your portfolio. We have a sample of that here where you can see what this would look like for a sample bank. And, we've also illustrated in that bar chart a distribution of the variances between the bank and the market. And you'd be surprised to see just how significant that variation can be for a sample bank. But this is a really great file to illustrate those opportunities. It's a flat file Excel delivery. It integrates very easily into a data mart or data lake, or if you're using a tool like Tableau to kind of visualize opportunities. Again, it feeds very well into those kind of platforms as well. It's fully customizable. So if you have certain parameters, if maybe industry is not as important to you, but you're really focused on collateral and geography and tenor, we'll customize the view to meet the ways that you analyze pricing. We can look at this both at an obligation level, like you see here. We can roll it up to a segment level if that's preferred, where you can actually give this. We've seen one bank roll it up to a segment level, so that way RMs can be given a market equivalent price and interest rate and fee level for any potential loan that would walk through the door. So it's just a really great way of being able to distill the market insights into a single file. We'd love to speak more with you about how this could help your bank. And I believe, Renee, on the next slide, our contact information is on this slide. Again, as Don said, these webinars are in many ways client-driven. We really appreciate all the banks that support our service and subscribe to the pricing dashboard. We really appreciate all the banks that attend these webinars and give us good feedback. If you have any questions about our service, any questions about some of the trends we're seeing in the commercial loan space, or questions about ways that we can help you optimize risk and return at your bank, please, by all means, reach out to us. We love to have those conversations. So Renee, I think that concludes our 1Q market review. I know we have a few minutes left, so I want to leave some time for any questions or comments that may have come through the chat area.
Yeah, I'm looking, Jeremy, and it looks like we do not have any questions today. So with that, I would like to just remind you that we will be sending out an email tomorrow with a link so that you can listen to the webinar again and or share with a colleague at your bank who may not have been able to make it today. Additionally, this last slide here will be available in the deck so that if you do have any questions, you'll be able to reach out to the BI team here at AFS. So I'd like to thank everybody for attending, and we will see you next quarter. Have a good day.
Thanks, Renee.
Thanks.